Welcome to The Explainer. Today, we're unpacking the actual nuts and bolts of valuing assets, and specifically, how to practically calculate the equity risk premium. We're leaning heavily on the foundational principles from valuation guru Aswath Damodaran. If you've ever built a discounted cash flow model, you already know that the discount rate you choose is absolutely crucial. It can literally make or break your whole valuation. And the single biggest driver of that rate? The equity risk premium. Okay. Let's ground this with a bit of philosophy from Oscar Wilde. He famously said, "A cynic is someone who knows the price of everything but the value of nothing." Now, applied to financial markets, that's a perfect reminder that just seeing a ticker price flashing on a screen isn't anywhere close to understanding an asset's true intrinsic value. A shocking number of investors actually just play the bigger fool game, buying something simply hoping some bigger fool comes along and pays more for it later. We are definitely not doing that today. To avoid that trap, we're building a practitioner's tool belt to practically measure the price of risk. So, our agenda today: 1. The price of risk. 2. The historical approach. 3. Adjusting for country risk. 4. The implied equity premium. And finally, 5. Choosing the right premium. All right, jumping right into section 1, the price of risk, understanding the foundation. The really crucial thing to grasp here is that, in valuation, risk isn't just some vague, scary feeling of danger, it's math. It is defined statistically as the variance of actual returns around what we expect to happen. Basically, the bigger the variance, the riskier the asset. But here's the kicker. We aren't just pricing any risk. Because investors can easily diversify their portfolios to wipe out company-specific hiccups, the specific risk we are trying to measure and price is the non-diversifiable market risk. Essentially, we're asking, how much extra premium do you demand to take on the roller coaster of the broader market? Moving right along to section 2, the historical approach, the traditional tool for mature markets. Now, you might be thinking that looking back at history would just give us one universally agreed upon number, right? No way. If you look at analyst reports, they're using wildly different premiums, ranging anywhere from 4% all the way up to 12%. Why the massive gap? Well, it all boils down to 3 specific choices you have to make when building your model. First, your time frame. Do you use data all the way back to 1928 or just the last 10 years to catch the recent vibe? Second, your risk-free base. Are you using short-term T-bills or long-term T-bonds? And third, how exactly are you averaging that data? That third choice, averaging, is a massive fork in the road for practitioners. Choosing between arithmetic and geometric averages completely changes your whole output. Now, conventional wisdom sometimes leans toward the arithmetic average, which is just the simple mean. But empirical data shows that stock returns are often negatively correlated over time. Basically, a killer year might be followed by a total dud. Because of that, arithmetic averages actually tend to overstate the true premium. The geometric average, on the other hand, which uses compounded returns, is statistically way stronger when you're forecasting long-term expected returns, like for a 5 or 10-year DCF model. Just look at the insane spread in this data table. If you take the arithmetic average over short-term T-bills all the way back to 1928, you get this massive 7.62% premium. But say you only look at the decade from 2000 to 2010 and you use the geometric average over T-bonds, suddenly your expected premium completely tanks to a negative 4.11%. That's wild. For corporate finance, the most defensible gold standard is typically the geometric average over long-term treasury bonds using the longest time frame you've got. On this chart, that gives us a very sensible 4.31%. But quick caveat. We got to remember, this data suffers from massive survivor bias. The US market was one of the very few global markets to actually make it through the 20th century without totally crashing and burning, so even that 4.31% might be a bit overstated on a true global scale. Let's turn to section 3, adjusting for country risk, the emerging market tool. So when you're building a DCF model in a place like Brazil, Poland, or Malaysia, you literally cannot rely purely on their local historical stock data. It's basically meaningless. The history is way too short, and the volatility is through the roof. So instead, you absolutely have to start with a mature base rate, like that 4.31% US geometric average we just found, and mathematically stack a country risk premium on top of it. This beautifully illustrates how to practically do the math on that using relative equity market volatility. Say you're valuing an asset in Indonesia. You start with your mature US base premium. In this example, they're using 5.51%. Then you take the annual standard deviation of Indonesian stocks, let's say it's 35%, and you divide it by the US standard deviation, which is about 20%. You're essentially asking, okay, how much more volatile is Indonesia compared to the US? You multiply the base premium by that ratio, 35/20, and boom, you get a total equity risk premium of 9.64% for Indonesia. It perfectly isolates the country risk without having to trust spotty local data. All right, Section 4, the implied equity premium, the forward-looking tool. Now, instead of looking in the rearview mirror, this approach looks at right now. It's a real game changer because it completely dodges that historical survivor bias we talked about. By assuming the broader stock market is efficiently and correctly priced in the aggregate today, we define the implied equity premium as the exact required rate of return that we backsolve for using current index prices. It makes the whole thing highly dynamic. It literally shifts as stock prices and interest rates shift. To do this yourself, it's kind of like a giant math puzzle, but you already have most of the pieces. You only need 3 specific inputs to run a basic present value model. First, grab the current value of your market index, like the S&P 500. Second, estimate the expected cash flows or dividends for the upcoming year. And third, figure out the expected long-term growth rate of those earnings. Since the formula says the value of the index equals expected dividends divided by the required return minus the growth rate, well, you already have the value, the dividends, and the growth rate. You just use high school algebra to backsolve for the required return. Subtract today's risk-free rate from that, and you've got your implied equity premium. No digging through 80 years of history required. Bringing it home with Section 5, choosing the right premium, applying the tools in practice. So you're sitting in front of your spreadsheet. The cursor is blinking. Which of these equity risk premiums should you actually use in your valuation? Which one is going to get you to the true intrinsic value? It all boils down to 2 key things: your personal market views and your valuation mission. If you genuinely believe that markets are prone to making huge, aggregate mistakes and eventually mean revert back to historical norms, then you should absolutely stick with the historical premium. But if you think the market is generally pretty efficient at pricing things right now, you should use the implied premium. Also, think about your mission. If you're doing an M&A valuation or you're an equity research analyst, you usually have to be strictly market neutral. You can't inject your own historical bias. You've got to reflect how the market is pricing risk today, which totally points you to using the implied premium. As you dive into your next model, I want you to really ask yourself, are you accurately and thoughtfully pricing risk based on the actual asset? Or are you just blindly plugging in a 5% historical average, following the crowd of bigger fools and hoping for the best? By mastering these historical, country-adjusted, and implied approaches, you are officially done guessing. You're systematically pricing risk to find true intrinsic value. That's a wrap for this explainer. Keep questioning the numbers, and we'll see you next time.